Hello everyone, welcome to Legacy IAS Academy. Today afternoon there was a meeting of Monetary Policy Committee, that is MPC, which was headed by the present RBI Governor, and the outcome of this meeting was the repo rate remained unchanged at 4% and the reverse repo remained at 3.35%. So in this video we will see what is MPC, that is Monetary Policy Committee, and what is repo rate, what is reverse repo rate, and we will also be studying something called as SDF, that is Standing Development Facility. Okay, let's begin. What is the context? See here, the takeaways from MPC meeting: repo reverse repo rate unchanged, SDF introduced. Okay, in this context we will see what do you mean by monetary policy. You would have heard two terms, that is fiscal policy and the other one is monetary policy. So what do you understand by monetary policy? Monetary policy are the tools available with the Reserve Bank of India or the central bank for that matter in order to regulate the money supply. The controlling the overall supply of money that is available to the nation's bank, its consumers and its businesses. And these tools, in order to do all these activities, available with the central bank, and how the central bank uses this tools is the concept of monetary policy. Then what do you understand by fiscal policy? You have something called as fiscal policy. What is fiscal policy is the same tools available with the government. The same tools available with the government which are used in order to regulate the money supply are called as fiscal policy. One of the example of fiscal policy is the budget. Okay, that is being presented in the parliament. Budget is an example of fiscal policy. So now what is MPC? That is Monetary Policy Committee, and when was it introduced? Monetary Policy Committee was constituted under the section 45ZB of the Reserve Bank of India Act of 1934, and Monetary Policy Committee was formed with the mission of fixing the benchmark policy interest rate, that is repo rate. In order to fix the repo rate, Monetary Policy Committee was constituted, and the RBI Governor is the head of MPC. In the comment box, comment who is the present RBI Governor. Okay, and the two other members of RBI and 3 persons nominated by the government as its members. So totally Monetary Policy Committee is a 6-member body. As the chairman of MPC, the RBI governor has a casting vote, which means RBI governor is not supposed to vote in the first instance. If there is a tie, if there is a crucial vote, okay, only then the RBI governor, who is also the chairman of MPC, can vote. The MPC should meet at least 4 times a year. And the recent MPC review that happened today afternoon, that is 8th April, that is Friday afternoon, MPC review happened. And what is the outcome? See here, the policy repo rate, policy rate is also called as repo rate, and the reverse repo rate remained unchanged. Reverse repo was at 3.35%, repo rate remained constant at 4%. Okay, in the same context, comment in the comment box, what is the repo rate minus reverse repo rate? Okay, there is a particular term which is used, which is coined when you subtract repo rate, that is 4%, from reverse repo, that is 3.35%. If it is subtracted, how much do you get? How much do you get? You get 0.65%. What is this 0.65% called as? Okay, and why is it important? I want you to comment in the comment box. Go to your standard source, static source, know what is the term called when you subtract repo rate and reverse repo rate, what is the difference that you get and what is its significance. Comment in the comment box. Along with the maintaining the repo rate and the reverse repo rate, the RBI introduced something called as Standing Deposit Facility, that is SDF, Standing Deposit Facility. What is SDF? Okay, we will understand it. At the same time, you can see here RBI also cut its growth projections for the financial year 2022 and 23. Okay, and also it hiked the inflation forecast at 5.7%. What is reverse repo rate? What is reverse repo? You know that the repo rate, and now let's understand what is reverse repo. It's just the opposite of repo. For example, if this is RBI for that matter, imagine a bank. In case of reverse repo, banks deposit or place their money with RBI. In turn, RBI will pay the interest. So what is this interest is what was decided by the Monetary Policy Committee, that is 3.35% would be the interest paid by the RBI to banks for whatever the funds or the money that is kept with the RBI by the banks. Okay, this is the entire concept of reverse repo, and the opposite is repo. This stable repo rate, reverse repo rate means that the central bank wants to retain the money or liquidity in the banking system. This is the entire concept of reverse repo rate. Now let's understand what is standard deposit facility or SDF, which was recently introduced in the MPC meeting. The SDF will be an additional tool for absorbing liquidity without any collateral, which means the same example we'll see. This is an RBI and this is a bank. We have seen in the reverse repo rate, banks would place the funds with the RBI and RBI would provide collateral to the banks along with the interest rate of 3.35%, which we called it as reverse repo rate. But remember, the only difference between standing deposit facility and the reverse repo is that the collateral that would be provided by the RBI. When you're dealing with the reverse repo, the collateral would be provided. In case of SDF, that is standard deposit facility, this collateral or a guarantee for that matter will not be provided by the RBI. Why? Why do you think the RBI will not be providing any guarantee for the banks which would be placing its funds with RBI? Because imagine a situation during the demonetization, which is famously called as demonetization. What happened was people started exchanging their currency. So in that case, banks had a lot of money. So when banks had a lot of money, they did not have the actual collateral or the security for that matter. They did not have the security in order to cater to this huge money. So if at all during this context happens, if at all this type of context happens, then the RBI will not have many securities in order to give to the banks as a collateral for the funds that they place. Getting my point? So if the collateral is not being given to the banks, which means the risk of default is more, so bank is taking kind of risk. In order to cater to this risk, the interest rate while carrying out the SDF would be more. So this makes sense. The interest rate should be more. This interest rate is more because of the risk that the bank is taking by not having a collateral or a guarantee of the RBI. So what is the interest rate here? What is the SDF interest rate? Let's see. This will allow the RBI to absorb surplus funds from the banks without collateral. So the interest rate for the SDF would be 3.75%. For the reverse repo, the interest rate that we saw was 3.35%. For SDF, it would be 3.75%. What is the growth projections according to MPC and the inflation projections for the year 2022 and 2023? The central bank slashed the growth forecast to 7.2%, which was earlier predicted to be 7.8%. And this happened in the wake of the Russian invasion on Ukraine and also the inflation. The inflation forecast was earlier 4.5% and it increased to 5.7%. Whenever there's inflation, we have studied that there will be depreciation in the currency, or the value of currency reduces. That's all for the today. We have understood the recent MPC review and we have understood what the Reserve Bank has taken as a stance, accommodative stance that the Reserve Bank has taken in the recent MPC review. For more such enriching content, please subscribe to Legacy IAS Academy. Have a nice day. Thank you.